Hello, students, and welcome to the ACE Archive. Today, we're going to make financial planning and capital structure incredibly easy to understand. If you're prepping for your Class 12 Business Studies board exams, you are in the exact right place. We'll be breaking down these core concepts using real-world Indian business examples to make sure you're totally ready. Let's jump right in.
Here is a quick look at our roadmap for today's explainer. We'll cover what financial planning is, its objectives, its importance, the mechanics of capital structure, and finally, a really crucial EPS analysis.
All right, Section 1, let's define what financial planning actually is and build our foundation.
Every single successful business out there needs money to survive and grow, right? Financial planning is simply estimating exactly how much money a business is going to need in the future, whether it's short-term working capital to pay daily wages or long-term funds to buy a massive new factory. You've got to look ahead and plan for those requirements.
Moving on to Section 2. Now that we know what it is, what are the primary objectives?
Well, it basically comes down to a really delicate balancing act. You have two main goals. Objective 1 is ensuring you have funds available whenever you need them. But Objective 2 is equally important. You absolutely must avoid raising resources unnecessarily. You want the right amount of money at the exact right time without going overboard.
Let's look at that first goal. You need to ensure your organization always has enough funds ready to go for your investments. Think about Reliance Jio's massive 5G network rollout. That required thousands of crores in investment. Proper financial planning was absolutely essential to ensure that money was available the exact second their engineering teams needed to buy equipment and lay down cables.
But on the flip side, hoarding a giant pile of idle cash is a terrible idea. If you borrow money unnecessarily, you're paying interest on it for absolutely no reason. Imagine if Zomato borrowed millions just to let it sit in a bank account doing nothing. They'd still have to pay compulsory interest on that debt, which literally just drains their profits. So we avoid raising unnecessary funds.
Okay, Section 3. We know the objectives, but what are the tangible, day-to-day benefits? Why is this so important?
First up, forecasting. Proper planning acts kind of like a telescope. It lets managers look into the future. Take Maruti Suzuki, for example. They have to plan their car production and buy raw materials months before the big festive season demand actually hits. Financial planning gives them the exact forecast so they have the money ready to ramp up that production. Number 2, avoiding uncertainties. Having your funding sorted out ahead of time means you can survive sudden crises. Indigo Airlines is a fantastic example of this. When the COVID-19 pandemic caused massive, unexpected disruptions across the entire travel industry, airlines with strong financial preparedness and emergency funds survived the storm much better than those who were just scraping by month to month.
Benefit number 3 is coordination. Financial planning acts like the glue holding a company together. Think of Amul. They have to perfectly coordinate milk collection from thousands of farmers, process it in huge dairy plants, and then ship it all over India. Having a solid financial plan ensures the procurement team, the factory workers, and the delivery drivers all have their budgets aligned and working in perfect harmony.
Fourth, it drastically reduces wastages. Without a plan, money just leaks out of a business. Large institutions, like the State Bank of India, rely on centralized financial planning. This ensures different regional branches aren't accidentally duplicating their efforts, like spending twice on the exact same software or running overlapping marketing campaigns. It stops the waste before it happens.
And the fifth benefit is easy evaluation. A clear financial plan gives you a baseline to measure your actual performance against. If Tata Motors budgets 500 crores for a new car launch campaign, managers can look back at the end of the year and easily evaluate if they stayed on budget or overspent. It makes performance tracking super straightforward.
All right, Section 4. Let's shift gears from planning the money to figuring out where we actually get it from.
Capital structure is essentially the mix of debt and equity a company uses to fund itself. Think of equity as owner's funds. It's safer for the company because paying dividends isn't compulsory, but it's usually an expensive source of finance. Debt, on the other hand, is borrowed money. It's cheaper, but much riskier because you absolutely have to pay that interest no matter what. The goal is to find the perfect mix of the two to maximize shareholder wealth.
Let's dive into a classic exam scenario to see how this works in practice. Imagine we've got a total investment of 50 lakhs. Our earnings before interest and tax, or EBIT, is 7 lakhs. The interest rate on our debt is 10% and the corporate tax rate is 30%. Now notice that our return on investment is 14%. Because that 14% ROI is strictly greater than our 10% interest rate, borrowing money will actually help us. This is a golden rule called trading on equity. Let's test this out across 3 different situations.
In situation 1, we play it totally safe. 100% equity, meaning zero debt. We deduct zero interest from our 7 lakh earnings, pay our 30% tax, and we're left with 4,90,000. You divide that by our 50,000 equity shares, and our earnings per share comes out to 0.98 rupees.
Now let's look at situation 2. We mix it up with 40 lakhs in equity and 10 lakhs in debt. Because of the debt, we now have to pay 1 lakh in interest. After taxes, our total pool of earnings is lower, yes. But here's the magic. Because we use debt, we have fewer equity shares floating around. So our earnings per share actually goes up to 1.05 rupees.
And check out what happens in situation 3. We bump the debt up to 20 lakhs, leaving only 30 lakhs in equity. We pay even more interest now, 2 lakhs. But our pool of shares has shrunk so much that the remaining profit is split among far fewer people. Our EPS shoots up to a massive 1.16 rupees. The takeaway? As long as your return is higher than your borrowing cost, adding debt makes your shareholders wealthier.
Let's do a super quick recap of everything we've covered. Financial planning is all about estimating your needs so you have funds available, without sitting on idle cash. It helps you forecast, coordinate, and survive uncertainties. And when it comes to capital structure, as long as your ROI is higher than your interest rate, using debt strategically will directly drive up your earnings per share.
So here's a question for you to chew on. If you were launching your very own startup tomorrow, would you play it completely safe with pure equity, or would you take the calculated risk of debt to multiply your own earnings? Think about that as you prep for your exam. Understanding the math behind the money is exactly what separates a good manager from a great one. If you found this explainer helpful, make sure to like, share, and subscribe to the ACE Archive. Good luck studying, and I'll see you in the next lesson.